Welcome to class 12 accounting for partnership fundamentals. Actually, I'm combining a few videos I did before. They were short videos, 10 minutes, 15 minutes and all that. And I uploaded and as expected, no one is watching. So I'm combining them. That introductory theory section, and then I will go straight to numerical sums. We will do 4 or 5 illustrations, hopefully. All right, okay. Now let us see the theory thing. Partnership firm is a business jointly owned by 2 or more persons. Okay. And the definition is given in Indian Partnership Act of 1932. It is Section 4 of the Partnership Act. And that definition is talking about the relation between, it's not talking about the business, it's more about the agreement. It is what is a partnership? It's not the partnership business or the building or that thing, the definition talking about. It is telling about the relationship. So relation between persons. Okay, that relation, this definition is a short definition, has all the features of a partnership business. Okay, so you don't have to study the features separately, learn the definition, and then the features are all included in it. Okay, relation between persons. See, there are 2 or more persons doing the business who are known as partners, who have agreed to share profits of a business. Okay, there is a business and the partners have agreed to sharing of profit. There is a business carried on by all. Okay, that is principal agency thing. Okay, or any one of them acting for all. So that definition has all the features of a partnership business. First of all, there is an agreement between people, and there must be 2 or more persons to do the business, and they will conduct a business and they will share profits. Okay, that's what given as the features of partnership. Definition is highlighting this: 2 or more people, there is an agreement, there is a business, and profits are shared by them, and any one of them or all of them will conduct the business. That's it. So characteristics, again, is the same thing. An agreement between the partners is known as, okay, there is mutual agency thing that you must know. Mutual agency, okay, among all the other features, okay, the others are all self-explanatory. By just looking at it, you know what it is. Agreement or 2 or more owners, agreement, business, sharing of profits. But only thing, mutual agency is something you need to know very well. So there is a relation between the business and the owner, between the owners. Mutual agency means one owner can speak for the others. In other words, an act by one partner on behalf of the business will be binding on all other partners. Means as if they also have done. They cannot disown the responsibility. They cannot say that we are not responsible. All of them are responsible for the act of one person. Any one person can do something. Suppose if he makes an agreement, if one partner makes an agreement, it is as if everybody made the agreement. Okay, so one partner can bind others by his action. This is known as principal agency relationship. Okay. Now partnership deed. Partnership deed is the written agreement between partners. Now there is a common question: is it necessary or is it compulsory that the partnership agreement should be in writing? Okay. Legally speaking, it is not compulsory. You can have agreement without writing. There can be verbal agreement. You can just say that, okay, we agree with this thing. So agreement doesn't have to be in writing. but it is a matter of common sense. Why there should be a written agreement? Because this will avoid future disagreement or dispute between partners. So if there is a confusion, if there is anything, so you need to have a written agreement. So almost every partnership business will have a written agreement, and that written agreement is known as partnership deed. Again, content of partnership deed, you don't have to learn it by heart. There are 14 or 13 or 14 points given there. It is a common sense thing, just to have a quick look at the features, content, items, and you will know it automatically if you are making a partnership agreement. What are the points you will include? What are the things you will include in that agreement? That is a question. You will know naturally, you know that name, address of the business, name of the partners, nature of the business, what is the arrangement for profit. Okay, don't try to learn it by heart. Okay, that's not what is expected. You just have a quick look, and you should be able to write some at least 5 or 8 points without making any specific effort. This is a common sense thing. Name of the business, name of the partners, nature of the business, profit sharing agreement, duty, responsibility, accounting, auditing, and maintenance of bank account. So just go through the list and you will be able to remember at least 5 or 6 of them. That is enough. Okay, then the certain rules applied in the absence of a written agreement. If you don't have it in writing in the agreement, or if the agreement is silent about something, what is the rule? For example, salary. If the agreement doesn't say anything, that doesn't mean that everybody can claim salary. No, everybody cannot. Everything is no, except interest on loan. Okay, salary. If it is not mentioned, no salary. Interest on capital, not mentioned, no interest on salary. Interest on drawings, not mentioned, no interest. So, if the agreement is silent, that means the decision is negative. No is the decision. Salary, no. Interest on capital, no. Interest on drawings, no. Only thing, interest on loan given to the partnership business, even if the agreement is silent, or if the agreement doesn't say anything, partner is entitled to 6%, and that is only one having a positive decision if the agreement is silent. And again, profit sharing, if nothing is mentioned about the profit, it can confuse you. You may think, okay, based on the capital, based on the effort or anything. No. If someone is a partner and if there is no specific profit sharing ratio mentioned in the partnership agreement, profit or loss has to be shared equally. Okay. So if there is no specific agreement, equal sharing of profit or loss made by the business. Okay, now some special aspects. Fixed and fluctuating capital accounts. Okay, by looking at this, you will think it's something very big. Fixed capital, fluctuating capital, it's nothing. I tell you, fixed capital means you make all the entries means normally partner salary, interest on capital, interest. All such entries will be made in a current account, and the capital account will be left intact. You won't make any entry, just opening balance, closing balance brought down, balance carried down. That's all. So that is called fixed capital account. So if the entries are all partners related entries are passed through or entered in the capital account, that's where normally you expect. Last year you studied sole proprietorship. So in sole trading business, there is no fixed capital, fluctuating capital. Capital is fluctuating actually. But in partnership business, if the partners decide to keep their capital accounts fixed, they have to open a second account for normal debit and credits. debits and credits. If there is any income, interest on capitals, salaries, all these things will be credited there. Drawings, interest on drawings, these will be debited in the, normally debited in the capital account. In this case, if the partners want to keep the capital accounts fixed, they will make the entry through the current account. No need to say too much about it. Very simple thing. Capital account, opening balance, closing balance, same. So there is a current account where the entries are made. And regular transactions are not entered in capital. It is the same thing. Okay, just for the sake of mentioning 2-3 points, I just mentioned them there. So go through all of them. Okay, when you have any if you have any doubt or anything, or if the video is moving a little fast, you just stop it and then read them. And if there is any doubt, just write the comments. Okay. Okay, fixed capital. This is a simple illustration. I just okay, these are numbers are just imaginary numbers, just to show you how this is working. Now you can see the case of fixed capital. You see the capital account. January 1st, opening balance 30,000. 31st December, closing balance 30,000. So that is the only entry. Just balance carried on, balance brought down. So all normal entries will be carried out through a current account. I just wanted to show you how it works, because there is no question given there. So these are all imaginary numbers. So salary, commission, interest on capital, and net debits, all these things are normally credited to capital account. In this case, we don't want to touch the capital. Okay, don't touch the capital account and create another account. This is practically, it is capital account, and we call it current account, and where all the credit items will be credited in current account and the debit here and balance. So partners' real capital balance is at the end of the year is 30 plus 5, 35,000. Beginning of the year, 30 plus 2, 32,000. So now we will see a normal account, that is the fluctuating capital. This is the normal thing. Fluctuating capital is a normal thing. And in this case, 30 and 2, I put them together, 32,000, and closing balance you will see 30 and 5, 35,000. Okay. So that's all. So all other entries, salary, commission, everything will be credited or debited in the capital accounts. So your capital account will be fluctuating. In the beginning it was 32,000, now the balance is 35,000. But in this case, where the capital account is fixed, started with 30, ended with 30. So that is the difference between the two. Now let's go to the next aspect, that is division of profit among partners. You did not see this problem last year because it was sole proprietorship that you studied, and there is no division of profit. In partnership, partners have to share the profits or losses, and of course they will have many other things other than just net profit. Dividing the net profit, okay, if it is only net profit, you can do it in the profit and loss account. But in addition to net profit, there are many other things. They are all part of they are not expenses. They are not charged against profit, charged against the profit and loss account, not a charge in the profit and loss, not an expense. It is an these are all, most of them are appropriation of profit. So profit, we will open an account called profit and loss appropriation account. This is actually part 3 of the income statement. Trading account, profit and loss account, profit and loss appropriation account, and then we go to balance sheet. Okay, so this is an extra statement prepared at the end of the year after the profit and loss account. Now look at the illustration. A and B are equal partners with capitals of 75,000 and 50,000 on 1st January 2020. A is entitled to a salary of 24,000 and B is entitled to 18,000, and they have withdrawn half of their salary. See, go through all of them step by step. We will just we have to do the profit and loss appropriation account. That is only one account. Then capital accounts, assuming that the capitals are fluctuating. That is the first thing. And the same thing again, capital and current accounts, assuming that the capitals are fixed. Okay. Now go to profit and loss appropriation and we will finish that. Okay. All the answers are there. They had, where is the profit? They made a profit of rupees 80. That is the first entry before reading anything. When you see this profit and loss appropriation question, just locate the net profit. Okay, if this can come for 4 marks, 3 marks or 4 marks. So don't spend too much time with this. Locate the profit, just mark the net profit and put it there first, credit side. If it is a loss, you will start with the debit entry. If it is profit, you will start with the credit entry, net profit. Now we are dividing this net profit to partners. First you will salary, interest on capital, all these things we will give from this 84. Okay. Now first thing is salary. A is salary, 24,000. You can see it there. A is entitled to 24,000 and B is entitled to, A is entitled to 24, B is entitled to 18. Okay. So 24 and 18,000. Okay, by the way, I remind you, please sit with a notebook and pen. Don't simply watch this like you watch a TV show or something. that way you won't get anything from this simply by watching. Work out the questions, just work out the sum, keep the answers, means keep the notebook ready and then do it with me. Okay, side by side. As I highlight something, you just prepare the accounts. Okay, that way you can make full use of the class. Okay, 24,000 A and 18,000 B. That is step 1. So we divided this. 24 and 18 divided, and then what is left? I think it is only, okay, let's keep an eye on this also. 84,000, yeah, 84 minus 24, that is given to A, and 18,000 given to B. So now we have 42,000. Commission to A and commission to B. What is mentioned here about the commission? Commission at the rate of A and B are entitled to commission at the rate of 5% and 3% respectively. That is, A will get 5% commission, B will get 3% commission on what? On the net profit after salary. What is the net profit after salary? 42,000. Okay. Net profit before salary was 84,000 and we have distributed 24 and 18. Means we have given salaries to 2 partners and the balance available is 42,000. And on this 42,000, 5% commission is given to A and 3% commission is given to B, and whatever is left will be divided in equal proportion. They are equal partners. Okay, so 42,000 into 5% into 5 by 100. What is this? Into 5 by 2,100, and again 42 into 3 by 100, 1,260, 2,100 and 1,260 given to A and B as their commission. Okay, commission to A and commission to B, and divisible profit is, okay, 42,000 minus 2,100, that is given to A, and what was given to B? 1260. 1260 given to this one. So we have 38,640 is available for these two partners. Okay, I have it here. 38,640 is available for the as the final profit, and this is divided by 2, equally divided. So A will get 19,320, B will get 19,320. That's the end of the story. Okay, so this is the final profit given to A and B. Don't worry about the color change or anything. It is 19,320, 19,320 each, and now we prepare the capital accounts. So keep these numbers in your mind so that I can avoid going back and forth. Okay. Capital accounts, opening balance anyway, it was given 75 and 50,000 respectively. Salary credited to A, salary commission credited to. Okay, if you are asked to prepare journal entries, first you think of the ledger and then go to journal. Okay. Last year you studied journal first and then ledger, posting to ledger. So that is not how it happens in the real life. When you come to higher classes, first you think of what you want in the ledger. Accordingly, you have to frame the journal entries. Okay, now salary 24,000, 18,000. Journal entry is profit and loss appropriation account debtor to A is capital, B is capital, 24 and 18. Commission, same thing, profit and loss appropriation account debtor to A, debtor to B. And net profit is enough. Net divisible, because net profit was given there as 84,000. So now that 84,000 is becoming, so take all of them together, you will get 84,000. 24, 18, 2,100, 1,260, 19,320, and 19,320 is 84,000 in fact. Okay, so that is credited, and then the balance will become 108 for A and 79 for B, and appropriation is finished. So when the capitals are fixed, you will just have opening balance, closing balance. You have a capital account that is only the balances. Entries are recorded in a separate account. Just this is a subsidiary account called current account. Salary, these are numbers are same. Salary, commission, net divisible profit, and then the drawings and the balance 33,420, 33,420 and 29,580 as current account. So balance in actual investment means actual claim at the end of the year is 75 plus 33 is A's balance, 50 plus 29 is B's balance. But we do not want to make any change in the capital accounts, so we want the capital accounts to stay as it is, and then we have all these things, all the entries in the current account. Now go to illustration 3. Go through the question. I hope you have completed the other one, means including the working notes. Now look at the question here. A and B. I'm going little fast because you have the convenience of stopping, going back and all that. So this is online class. It is coming to us video. So these little bit of conveniences are there, so we can go faster. If it is a regular class with whiteboard and marker, it will take that one class will take more than half an hour. This is now only 24 minutes. Okay, 24, 26 minutes now, and we could cover quite a lot. Now, question number 3, illustration 3. They started business with 75 and 50,000, just like before. And the drawings account showed debit in balance of 8,000. It's the same thing. Debit balance of this means drawings account showed they have withdrawn A had withdrawn 8,000 and B had withdrawn 5,000. Partnership deed provided for interest on capital, yes, 6% interest on capital, but okay, interest on drawings is charged 3% on the closing balance. Just okay, this is very simple, oversimplified. I purposely made it easy. In the beginning, I don't want you to get confused with the date and all that. Okay, now on the closing balance of drawings account, irrespective of the date of drawing. So otherwise, normally interest on drawing is calculated on the basis of period of drawing, means how long the partner used the money. So if you withdraw 500 in the beginning of the year, January, and another 500 at the end of the year, so the total is 1,000, but the interest has to be different. Beginning of the year means you have to pay 12 months interest. End of the year, only 1 month, December 1st means you have to pay only 1 month interest. Okay, this thing we will discuss in detail at a later stage. At the moment, we focus on appropriation only. So I don't want to teach you anything other than appropriation. So that is why I'm not giving you complicated questions of interest on drawings, interest on capital and all that. So simple profit and loss appropriation. Okay. And more detailed questions we will discuss at a later stage. Okay, not here. So the profit is 22,110. First, interest on capital. That is we will start with the appropriation first. Interest on capital. Interest on capital is allowed on the opening capitals. 6%. 6% on 75 and 50,000. 6% of 75,000 into 6 by 100, 4,500, and on 50,000 it is, so 4,500 and 3,000, that's enough. And then interest on drawings on the closing amount. A has a debit of 8,000 and B has a debit of 5,000, 8,000 and 5,000, and the rate is 3%, right? Very fair, good. So interest on drawings is a debit in the capital account, becomes a credit in appropriation account. Please remember, you should not learn where to show the entries. Never try to learn it by heart. See this one. Interest on capital is something you give it to partner. So take from the appropriation. Take them this 20 from this 22 and give A 4,500. Okay. Why I am saying this? Because then only you will understand how this is interest on drawings are treated. Okay. So have a clear picture. Interest on capital is given to partners. Taken from profit, given to partners. Now here, interest on drawings is taken from partners and added to profit. So now this is taken from A on 8,000, 8 into 3 by 100, so 240, and B 150. Taken from A, given to partnership. Okay, so it will go back to A ultimately, but this is how we do it. This is how the entry should be. Okay, step 1, taken from A, that we will see in the capital account. Okay, that we will see in the capital account. Debit of A and credit of appropriation Appropriation is actually combined capital account. This is partner's account. Taken from partner, put it back here. Taken from B, put it here. So now you add up 22,500 and minus this 2 and you will get 15,000. 15,000 divided by 2, you get 7,500 each. So appropriation is finished. And now we will go to prepare profit and loss appropriation and capital accounts of the partners. Okay, the question doesn't say anything about, doesn't say whether it is fixed capital fluctuating. Do not assume the capital is going to be fixed, or don't try to open the current account. Just do it normally. Just start to do the normal capital accounts. Okay, capital accounts of partners started with 75 and 50. They started business, that is why by cash, otherwise it is by balance brought down. In this case, they started business, so that's why I wrote by cash. Okay, opening capital. Now interest on capital is given to partners. Anything you give it to them will be credited here. Okay, taken from appropriation. Appropriation means A and B combined. Profit, okay. Profit and loss appropriation is actually the combined capital taken from the partnership given to individual partners. Now taken from the individual partners given to the partnership. I mentioned it before. From A you take interest on drawings. Okay. So please understand the logic very well. Okay. If this logic is not clear, you will have confusion all the time. Anything you want to give to partners, give it on the credit side. Anything you want to take from them, do it on the debit side. Interest on capital, interest on drawings, and drawings of course will come to the debit of capital. And then finally net profit, that 15,000 is divided, you see here. Give it to partners. Yes, partners got it. And now finally the balances 78,760 and 55,350. That's the end of the story. Okay. So if this is clear, go to the next one. If it is not clear, go back and watch this again. Still not clear. There is nothing. It is not complicated or anything. It is easy. Still not clear. Write a comment. I will explain it. Now the fourth illustration, A and B started business with 15,000 each. On 1st January 2000, I made them monthly drawings of 750. B made them monthly drawings of 500 from the business. Profit for the amount to 18,000. The partners entitled to interest on capitals. Thank God no interest is charged on drawings, because this is monthly drawings. Your work is slightly complicated. Monthly drawings means I should mention whether they are drawing in the beginning of the month, middle of the month, or end of the month. So these three things have three different treatments. Not a big deal. It is a very simple, silly thing. Okay, we will see it at a later stage in this chapter. But right now, no interest is charged on drawings. Only thing, remember, A is making a monthly drawing of 750 into 12. B's drawing is 500 into 12. 500 into 12 is almost 6,000. And naturally, this man is 6,000 plus 3,000, that is 9,000. That's all. Now let us go to the profit and loss appropriation account. Start with the net profit. Where is the net profit? Their profit for the year. This is the first information. Okay, whenever you get a question, just locate this information, mark it, underline this one, and start doing the answer now. Profit and loss appropriation account, 18,000, good. Interest on capital, capital A, interest on capital A and B, 15,000 each. So interest on capital is equal 15,000 into 6%, I think, 15 into 6 by 100, 900 each. A will get 900, B will get 900, and then there should be No, wait. There is no interest on drawings. Okay. No interest is charged on drawings. Okay. So we will go to the division of final profit, that is 16,200 is the leftover. 18,000 minus 1,800 is divided. Okay. 18,000 minus 900 minus one more 900, 16,200 divided by 2, 8,100 each. So this is given to A and B. That's okay. Now we will go to the capital accounts. Capital accounts of A, capital accounts of B. Together. So I kept this account separate. Okay, because of some space constraint, maybe in the coming sums I will combine the capital account, means common particulars column and different amount columns. Okay, 15,000, A is 15, B is 15, that is opening capital. Okay, this is an easy sum. Okay, interest on capital and net profit, that's all. It's all same. Interest on capital and net profit. Interest on capital, B also same thing. Interest on capital and net profit. This is over simplified question. A is drawing 9,000, B is drawing 6,000. So A has 15,000, B has 18,000 because his withdrawal is 3,000 less. So his closing balance is 3,000 more. All right. Okay. So that's the end of this question. We will go to illustration 5. A and B started business with the capital. I just kept it same, purposely kept it same so that you can focus on something more interesting. 75 and 50. They have agreed to share profits and losses 3:2. Normally, usually we see equal partners, but in this case 3:2. Salary of A is entitled to 12,000 and B is this is the first time we see B is more important now. Usually A gets more and B gets less. So there is no rule like that. I just wanted to highlight this difference. Means there is no specific rule that A should be bigger one or B should be. It just happens that way. Okay. Interest at a flat rate of 5% would be allowed, charged on drawings exceeding the amount. Interest, flat rate of 5%. Flat rate of, no, notice this. Flat rate of 5%. So you don't have to worry about the period. Okay. Second thing, drawings exceeding the amount of salary. That means if their drawings in case of A up to 12,000, no interest. If his drawing is 13 or 20 or something, then for that extra amount you have to pay interest. He has to pay interest. Okay. Now A's total drawings 20,000. You can see it exceeds 12. So he has to pay interest on drawings for 8,000. Did you notice this? He is normally he can freely take 12,000. It's allowed to take 12,000 without interest. Beyond 12, he has to pay interest. So interest on drawings will be calculated on 8,000 rupees. And in case of this man, he is entitled to how much? 18,000, whereas he took 23,000, right? 23. So there is 5,000 more and he has to pay interest on drawings for that 5,000 extra amount. Okay. Profit prior to salary. This is more important. This is the first information. You have to look for the profit. That is your starting point. Always. Profit prior to partner salary amounted to rupees 44,000. This is your starting point. By P&L account, net profit 44,000. Now easy things. partner salary. A's salary, you remember, A is getting 12, B is getting 18. So that is done. And interest on drawings. A is to pay interest for 8,000, flat rate of 5%. Flat rate of 5%, right? Interest at the interest flat rate of 5%. Look at this. 5% on 8,000. Okay, I'm not explaining what is this 8,000. 5% of 8,000, and B is to pay interest 5% on 5,000. Okay. 5% on 8,000 is 400. 5% on 5,000 is 250. And then, so add up. You can see interest on capital. A's capital 75,000, so he will get 9,000 interest on capital, and this man gets 6,000 interest on capital. Now there is a problem here. These debits are more than the credit. Actually, it is something I overlooked. Should be in examination. You will not get something very close to each other. Means the total will be drastically different, so that you will know exactly that debit is more. Now in this case, this is actually credit is coming to little more than 40, means this is little short, less than 45. So there is no net divisible profit, you have a divisible loss, net loss, because the debits, we start with the 12,000. See this, 12,000 plus 18,000 plus 9,000 plus 6,000 is 45,000. Actually, I should have made this thing slightly bigger, so it is easy for you to know that there is a net loss, final loss. Now see the credit side. Credit side, you have 44,000 net profit plus 400 plus 250. Together you have 44,650. Okay, so credit is less, so you are to transfer a loss, that is 350, and that 350 will go to A and B in the profit sharing ratio, 3:2 ratio. Just like we transfer the profit, we can also transfer the loss. And in the strict sense, this is not a loss. In fact, the appropriations are more. They took salary and then they took interest on capital. So it is not a loss in the real sense, but some small complication because of this extra, because they have already appropriated bigger numbers. Okay, I hope this is clear to you. And now we will go to the capital accounts. It is capital 75, salary, interest on capital. Okay, these things anyway, you know this by now, clear. Salary, interest on capital, credited. Drawings and interest on drawings, debited. These are two debits, normal debits in capital accounts. And now this is an unusual thing, not very unusual, but unfamiliar. Okay, that's a better word. Usually we have net profit here on the credit side, but unfortunately here we have a net loss. But still you can see they started with 75 and they have in case of A, he has 75,390 in spite of withdrawing 20,000. So he took 20,000 and still he has 75,000. So the business is not bad. So they're not losing. Same thing in B's capital account also. go through them, do the capital account of B, and that's the end of it. Thanks for watching. See you in the next class. Bye. See you. Bye.